So you want to be a lazy king or queen, huh? You want to sit back, sip margaritas, and let your money just print you $1,000 every single month while you do absolutely nothing? Well, spoiler alert, it's possible, but only if you stop daydreaming like a broke TikToker and actually understand the math. Today, I'm breaking it all down. How much cash you need invested to make $1,000 a month in dividends. No guessing, no manifesting, just straight up numbers, some sarcasm, and maybe a few verbal slaps to wake you up. What's up, degenerates? My name's Peter, and this is Peter Finance, where we mix cold hard financial facts with just enough insult comedy to keep you from falling asleep like you would with those boring beige sweater finance gurus who sound like they're narrating a tax textbook. Unlike those dudes, I actually bring receipts, real data from the Federal Reserve, Bureau of Labor Statistics, and the SEC. So you can't argue with me, unless your name is Karen and arguing is literally your cardio. Before we go deeper, smash that like button like you smash your paycheck on Uber Eats, and subscribe if you actually want to escape being broke as forever. Let's paint the picture. The average American household spends around $5,577 a month, according to the latest Bureau of Labor Statistics Consumer Expenditure Survey. That's everything: housing, food, transportation, medical bills, and yes, probably way too many pumpkin spice lattes. Now, imagine if $1,000 of that came in passively. That's not pocket change. That's your rent covered in a cheaper city. That's groceries for a family of 4. That's literally enough to tell your boss, you know what, Brad? Take your 8 a.m. Monday meeting and shove it. But here's the problem. Most people think dividend income is this magical unicorn where you throw $500 into Robinhood and suddenly you're making it rain like a Wall Street Chad. No, my friend, you can't just invest the change in your couch cushions and expect a $1,000 monthly payout. Dividends work, but you gotta respect the math. Otherwise, you're just gambling. And spoiler alert, Vegas has better odds. Math breakdown, start. Let's crunch the actual numbers because math doesn't lie. Dividends are basically a company saying, hey, thanks for owning our stock. Here's some cash from our profits. Companies usually pay these quarterly, but for simplicity, let's translate it into monthly income. The key number here is dividend yield. That's just annual dividend per share divided by share price. Example, if a stock is $100 a share and pays $4 a year in dividends, that's a 4% dividend yield. Now, if you want $1,000 a month, that's $12,000 a year. So, how much do you need invested? Depends on your yield. At 3% yield, $12,000 divided by 0.03 equals $400,000 invested. At 4% yield, $12,000 divided by 0.04 equals $300,000 invested. At 5% yield, $12,000 divided by 0.05 equals $240,000 invested. And at 6% yield, $12,000 divided by 0.06 equals $200,000 invested. And here's where the internet clowns will try to trap you. You'll see YouTubers titled, "I retired off dividends with just $50,000. Nah, bruh, that's cap. Unless you're buying some scammy high-yield stock that's paying 20% before it crashes harder than crypto in 2022, you're not hitting $1,000 a month without stacking serious capital. Let me repeat this for the people in the back. You either need 6 figures invested, or you need to keep clocking in at that job where your boss has coffee breath and calls you champ. Let me make this even more relatable, because I know numbers can feel cold. $300,000 invested at 4% yield is like owning a money machine that spits out $1,000 a month. But how do you get there? The average U.S. worker makes $63,795 per year, Bureau of Labor Statistics 2024. After taxes, call it $50K take-home. If you save 20% of that, you're banking $10,000 a year. At that pace, it would take you 30 years to hit $300K, not even accounting for growth. But if you invest in the S&P 500, which historically returns around 10% annually before inflation, you could realistically build that $300K in about 15 years with consistent contributions. 15 years may sound like forever, but let's be honest, you've already wasted that much time watching Netflix originals that get canceled after one season. Let's put this side by side. Average broke Bob blows $400 a month on DoorDash, Starbucks, and self-care candles he can't afford. Ends the year with zero invested and wonders why his checking account looks like a sad desert. Smart investor Sam cuts half of that nonsense, puts $200 a month into a dividend ETF like VYM or CHD, reinvests dividends, and slowly builds a portfolio that actually spits cash back at him. Over 20 years, Bob is still broke as working for DoorDash. Sam's getting $1,000 to sit in his boxers and argue about fantasy football. Here's another trap: chasing high yields. You see a stock with a 10% dividend yield and think, hell yeah, easy money. Wrong. If something looks too good to be true, it usually is. Companies with unsustainably high dividends are often red flags. They're either over-leveraged, losing revenue, or about to slash that dividend faster than you delete text from your ex. That's why dividend investors don't just chase yield, they look at dividend safety. Metrics like the payout ratio, dividends divided by earnings. If a company's paying out more than it earns, guess what? That dividend is living on borrowed time. So, your sweet 10% yield might last a year, maybe two, and then bam, you're left holding a stock that tanked 40% in price and doesn't even pay you anymore. Congrats, you just donated your money to corporate dumpster fire. Instead, smart dividend investors look for sustainable yields in the 3 to 5% range from reliable companies. Think Coca-Cola, Johnson & Johnson, or ETFs that spread risk across multiple companies. Let's zoom out. According to the Federal Reserve's 2023 survey of consumer finances, the median retirement account balance for Americans aged 55 to 64 is just $134,000. Yeah, that's median, meaning half have less, which means half of boomers are basically praying Social Security doesn't get cut because $134K invested at 4% yield only pays about $5,360 a year or $446 a month. That's not even half the rent for a one-bedroom in New York City. So, if you're sitting here thinking, I'll figure it out later, later is when you're 60, broke, and angrily writing Facebook posts about how avocado toast ruined the economy. Don't be that guy. Here's the good news. You don't need to start with $300K. Every $100 you invest compounds. Every dividend you reinvest snowballs. If you start in your 20s and consistently throw in even $200 to $500 a month, you're stacking your future freedom. Think about it. Would you rather be the 45-year-old still begging your boss for a 3% raise, or the 45-year-old whose portfolio is already covering half their bills? Dividends are slow, boring, and unsexy. But so is brushing your teeth, and not doing that ends badly too. All right, let's push this further. Because I know some of you are thinking, okay, Peter, but what if I don't want to wait 20 years stacking paper like some boomer? What if I want that $1,000 a month yesterday? Cool, let's run the fantasy math and then slap it with reality. Say you've got $100,000 right now. You want $12,000 a year. That means you'd need a 12% yield to hit your goal. Sounds awesome, right? Well, the last time legit companies paid 12% consistently, dinosaurs were still roaming Wall Street. High yield equals high risk. Companies paying that much are usually either about to cut the dividend or they're structured like REITs and BDCs where, yes, the yields are juicy, but the volatility can make you cry harder than a Karen getting banned from Target. Instead, if smart dividend investors look for sustainable yields in the 3 to 5% range from reliable companies, think Coca-Cola, Johnson & Johnson, or ETFs that spread risk across multiple companies. Now let's talk strategy. ETFs versus individual dividend stocks. Individual stocks, think Coca-Cola, Pepsi, Johnson & Johnson. Solid, consistent, but you need to research. You gotta dig into financials, payout ratios, debt levels, and if you don't, you're just gambling dressed up in a tie. ETFs. These are like buying a basket of dividend-paying stocks. Examples, VYM, Vanguard High Dividend Yield ETF, or CHD, Schwab US Dividend Equity. They yield around 3 to 4%, super diverse, and you don't need to play Sherlock Holmes with financial statements. So, if you're lazy, and let's be honest, half of you are, ETFs are the way to go. Because putting your future retirement on one company not going bankrupt is like betting your life savings on Chad remembering your birthday. Not reliable. Here's where the magic actually happens. Dividend reinvestment. Let's say you put $10,000 into SCHD, which has about a 3.5% yield. That's $350 in dividends your first year. Not impressive, I know. That's like 3 Chipotle runs after extra guac fees. But if you reinvest those dividends and keep adding money, compounding starts flaxing. Example, invest $500 a month into SCHD. That's $6,000 a year. At a 3.5% yield plus 7% capital growth, historical average, in 20 years, you're looking at around $275,000. That portfolio spits out about $9,600 annually in dividends, close to $800 a month. And that's just $500 a month. If you bump that to $1,000 a month, you're easily clearing your $1,000 a month dividend dream in less than 20 years. Compounding is boring, but so is watching paint dry, and both get the job done if you wait long enough. Think of reinvesting dividends like going to the gym. The first few months, you don't see shit. You're just sweaty, sore, and cranky. But after a couple years, you've got muscle and stamina, and suddenly people are asking you how you did it. Same thing here. For the first couple years, your dividends are puny. But if you stick with it, in 10-20 years, you've built a cash-flowing machine. Okay, let's be super literal. If you want $1,000 a month in dividends, here's a clean roadmap. Pick your target yield. Safe zone is 3 to 5%. Let's say 4%. Annual goal, $12,000 dividends. Required portfolio, $300,000. Timeline math. Save $500 a month, 10% return. You'll hit $300K in about 22 years. Save $1,000 a month, 10% return, around 15 years. Save $2,000 a month, 10% return, around 10 years. So it's not rocket science, it's consistency. The problem is most people can't even commit to a Netflix series past season 1, let alone a 15-year investment plan. Let's roast some broke behavior real quick. Buying a new iPhone every year when your old one works fine. Congrats, you just torched $1,200 that could have been invested. Eating out 4 nights a week because I don't have time to cook. Translation, I don't have time to not be broke. Keeping cash in the savings account earning 0.01%. That's like locking your money in a coffin and praying it resurrects. Meanwhile, people who cut just a couple of those habits are stacking extra hundreds every month into investments. Over years, that's the difference between broke Bob crying in his Corolla and smart investor Sam cruising with dividend checks. Here's something you don't hear often. The psychology of dividend income is a game changer. Think about it. Most people are terrified of selling stocks for income because it feels like killing the golden goose. Dividends, they're checks that just arrive. It feels like magic money, which makes it way easier to stay invested. That's why retirees love it. It's income without the guilt of selling. And for you, chasing that $1,000 a month goal is less about the number and more about training your brain. Once you realize your money can literally work harder than you, your whole perspective shifts. Suddenly, your job isn't the main course, it's just fuel for building the portfolio that eventually lets you say goodbye to your boss forever. Quick roast. Some of you are sitting here thinking, yeah, but $300K is impossible, I'll never get there. Okay, but you somehow managed to blow $80K on a lifted truck, $15K on crypto you sold at a loss, and $9K on OnlyFans over the past 3 years. Don't tell me you don't have the money, you just don't have priorities. Let's put this all together. $1,000 a month in dividends is $12K a year. At 4% yield, you need $300K invested. That can be built in 10-20 years depending on how much you invest consistently. ETFs make it brain-dead simple. Individual stocks if you're a nerd for spreadsheets. Reinvest dividends until you hit your income goal. Then you can switch to cashing out. Bottom line, it's not a dream, it's math. But math only works if you actually play the game. So here's my challenge. Instead of doom scrolling TikTok tonight, open your brokerage account and put $100 into a dividend ETF. Doesn't matter if it's tiny, that's your first brick. Keep stacking, and one day those bricks turn into a mansion that pays you rent. And if you're too lazy to even start with $100, then congrats, you've officially locked in your future as Broke Bob. Don't come crying when your retirement plan is, hopefully my kids don't hate me enough to dump me in a nursing home. Here's the brutal truth, my friends. Most people will never hit $1,000 a month in dividends. Not because it's impossible, but because they can't stay consistent for more than 30 days. They'll invest for a month, get bored, pull their money out to buy a PS5, and then whine on Reddit about how the system is rigged. Newsflash, the system is rigged, but that's exactly why you have to play it. The rich don't make their money from hourly wages. They make it from assets. Assets that spit out income whether they're working or binge-watching Love Island. You want proof? The Federal Reserve's 2022 data showed that the top 10% of households own 89% of all U.S. stocks. Yeah, 89%. That's why they get richer while average folks argue about gas prices. Dividends are literally a pipeline of cash, and the wealthy have been bathing in it for decades. Meanwhile, you're still debating whether to buy Starbucks today or not. Imagine two versions of you. Present you, tired, overworked, waiting for payday like it's Christmas. Future you, portfolio stacked, dividends hitting your account like clockwork, stress melting off your shoulders because your bills are covered by assets. Which version do you want to be? The choice is literally being made right now, every time you spend or invest. Stop guessing, stop hoping, stop scrolling through dividend memes on Instagram and start doing the math. $1,000 a month is not a pipe dream. It's a formula. Pick your yield, build the capital, stay consistent, reinvest until you hit your number. Simple. Not easy, but simple. So here's the deal. If you want to keep being broke Bob, close this video, keep buying random junk, and pray your boss gives you that 3% raise. But if you're serious about building a life where your money works harder than you, hit subscribe to Peter Finance because I'm dropping facts, stats, and the occasional roast until you actually get there. Like the video, share it with that one friend who thinks Dogecoin is a retirement plan, and comment down below, what would you do if you had $1,000 a month in dividends right now? Because guess what? The sooner you start, the sooner that answer becomes reality. Now, get off and invest.